And talk today about cost accounting and some of the um, intricacies of cost accounting. Cost accounting, my least favorite subject when I was an undergrad, though I got more into it as a grad student. And then when I was in the business world, I used it constantly. So a very important subject. Um, Calculating what something costs to do is not as simple as it might seem. Because we have different kinds of costs, and sometimes figuring out where those costs belong can be quite difficult. So I'm going to go sort of attack this and cover cost accounting in one half-hour lecture. So there's a lot to cover, and we're just going to look at the overall effects and theory behind cost accounting and why we need to do it and what it does. We're not going to get too deep into the weeds and figure out how to do it because we don't have enough time in this course. But it's important that you understand cost accounting, you know what it's used for, and you certainly, some of you may have already been involved in businesses where you were involved with cost accounting, but even if you haven't yet, you probably will be in the future. So first of all, some terminology. What's a cost? Something you give up to get something. Essentially, a sacrificed resource to achieve an objective. That's your highfalutin academic definition. Yeah, you got to pay for something to get it. Generally, the sacrificed resource is cash, but not always. The sacrificed resource might be some other kind of an asset that we're giving up in order to get something. An actual cost is a cost that's already been incurred or has already occurred. And a budgeted cost is a cost that we're predicting will occur. So throughout the discussion here, we're going to use that word budget. And remember, budgets are always predictions or estimates. They're not actual. And then cost object is anything that we want to figure out what it costs. So it can be a product, and in the case of products, it almost always is necessary to figure out what a product costs. But we may also want to know what a service costs or what some kind of an internal activity within the company, within the organization costs. So the internal activity might be, I don't know, preparing warranty documents for your products that you're selling. That's an internal activity. How much does that cost to prepare a warranty document? And we have the legal costs and the printing costs and all of those different kinds of costs, and then maybe we have some overhead costs. And so what does it cost to prepare one warranty document? I have to prepare them for all the different things I make. What's one cost? Obviously, that's important to know, perhaps. So let's look at an example. I'm going to use BMW as an example. And they have a plant in Spartanburg, South Carolina, and they build their SUVs there. So in that plant, they build the X5, and that's a product. So they would want to know how much does it cost to build an X5 in the plant in Spartanburg, South Carolina. They're probably also building other models of vehicle there, so it gets a little more complicated when you don't have a single product, you have multiple products. A service they provide to their dealers is a hotline. I've got this car and it's doing this or that, and I don't know how to fix it, or I don't know how this particular option works, or something. So they maintain a dealer support hotline, and they want to know what does it cost to maintain this, and maybe what does it cost per dealer or per call or per product line or per. They want to know, be able to isolate that cost and manage that cost. They may be doing some R&D projects. The example here, an R&D project on a new DVD system or a system enhancement. Well, what does that cost? How do I allocate the cost to that R&D? Maybe I'm doing R&D on a whole bunch of different things, and people are working on this DVD as well as a whole host of other projects. How do I figure out that cost? And then I might want to know the cost of an activity. So let's say when I switch from the X5 to the X7, if that's what their other model is called, What does it cost to change the production line to produce a different model? What's the cost of setting up those production machines to do something different than what they were doing before? So cost terminology, we're going to use these words, so we ought to know what they mean. Cost accumulation is basically capturing the data. And this is what accounting systems do. So accounting systems are good at cost accumulation. We track transactions and we accumulate those transactions in a ledger, and so we're accumulating costs. So we're pretty good at that. Accounting systems do that pretty well. Cost assignments, more difficult. So taking these costs and assigning them to a specific product is more difficult. So that would be assigning direct costs or indirect costs to an object. So I just threw some words out there, direct costs and indirect costs. So let's define those direct costs and indirect costs. Direct costs are costs that can be conveniently and economically tracked to a cost object. So if there's a cost that's directly related to the X5, it's easy to track that cost directly to the item, and that's clean. We're really comfortable with direct costs. Direct costs are generally very accurate. We know exactly what went into the automobile or whatever the product is, and we can track them directly. So those are easy to track, and those direct costs are accurate. Indirect costs can't be conveniently or economically tracked to a cost object. So they are overhead costs. Things like the supervisor's salary, and he's supervising X5s and other cars as well. The electricity in the plant if there's only a single meter. The cost of the plant itself, the lease cost or the building cost of the plant itself. Things like that are indirect, and we have to allocate those costs to different cost objects using some kind of what we call a cost driver. So those are the things that we have to do. So we're going to take an example here. The cost of the steel or the cost of the tires in this car are direct costs. So we can track them directly to the vehicle. So every car has 4 tires, and I'm going to assume that the BMW X5 has a spare that's a full-size spare. So we're going to take those 5 tires, and every car we build has those 5 tires. We can trace them directly to the car. Same thing with the steel, maybe a little bit more difficult because the steel comes in one form and then we have to bend it and twist it and make it something else. But the cost of the steel is, we pretty much know how much steel we've got in each car, so we know what the cost of the steel is. So that's pretty easy. The hard part comes with the indirect costs. So if we have a lease on the plant, in the Spartanburg plant, so we don't own it, we're leasing it, let's say we have a 20-year lease, we're paying X million or X $100,000 a year in lease costs, but we build other things than the X5 there. How do we allocate the lease costs to the X5? Well, there's lots of ways to do it. We want to find the way that provides the most accurate assignment of costs. Because if we over-assign costs to the X5, that means we're going to under-assign costs to the other vehicles and vice versa. And if we have incorrect cost information, we're going to make bad decisions. So we're going to decide to do things that maybe we shouldn't make bad price decisions. We may make bad promotion decisions. We may even decide to eliminate a product because we think it costs too much to produce. And maybe it does, but if it's because our cost data is wrong, we may be making the wrong decision. So really important to have good cost data and to carry it through. And this is where the problems come. It comes with indirect costs. So direct costs, generally parts and assembly line wages, are direct costs. We can directly trace them to this particular product. Indirect costs, electricity, rent, property taxes, These are overall costs that are necessary to run the plant, but it's hard to, or they are not directly traceable, so we have to allocate them using some method, which we call a cost driver, to the different products that we make in the plant. When we're figuring out how to classify items, we may be interested in materiality, and we may be interested in what it costs to apply them. So we may have some things, for instance, that are direct costs that we may not, they're so small that we may not bother to directly trace them to a particular cost object, to a particular vehicle in this case. So maybe we use, I don't know, some kind of glue in all of the models of the cars that we produce, but overall, year round, we spend $5,000 on glue. Do we really want to trace exactly how much glue we're using on an X5 or on an X7 or an X3 or whatever other cars we build there? Is it worth it to trace the use of the glue? Probably not. So in most processes, there are things that are just too small to worry about. I often use the example in my on-campus classes of the markers that we write on the whiteboards with. Is it worth tracking or tracing those markers as a cost of instruction, or is it better to just expense those things and apply them randomly? I mean, there's such small amounts of dollars, it may not be worth tracing and tracking those things. So we decide whether we're going to trace or track it, especially in a direct method, by whether the cost is material and whether it's too expensive to gather the information. Remember, it's always better to have items be direct costs than indirect, because when they're direct costs, we can trace them directly to the product, and that gives you a better answer, or an always more accurate answer. The other thing that happens with cost-benefit analysis is as information processing gets more efficient, we may find something that used to be too expensive to track from a cost-benefit standpoint becomes easier to track, and we may start tracking it. The other thing about costs is, we've talked about this before, but we're going to revisit this, is that there are things that are variable costs and there are fixed costs, and they act differently. So variable costs change based on the level of volume or activity, and fixed costs remain unchanged no matter what the volume or activity is. And this is only accurate within what's called a relevant range. So we can only use these estimates of variable and fixed costs within some range of activity. So as an example, if I'm running a company and I have a distribution center, and I know what my variable costs in the distribution center are, and I know what my fixed cost of the distribution center is, and within some range of volume, I can continue to use that single distribution center. At some point, when I get outside the relevant range, I actually have to build a second distribution center in order to handle the volume, and therefore my fixed costs change dramatically at that point. I have to build another building, which becomes a fixed cost. So the fixed costs that we use in cost accounting are accurate within a relevant range, within a range of activity. So that's an important concept. Some other things, I've already mentioned the word cost driver. So cost driver is whatever action is that actually causes costs to change. So cost drivers are things that change, that cause costs to change. And we've already talked a little bit about relevant range and the fact that costs are fixed and variable, accurately fixed and variable in a relevant range. So here's a summary of what we've talked about. We have variable costs. They change in proportion with output. But in terms of a per unit cost, they're unchanged in relation to output. So if it costs me $3 per car to put an antenna on a BMW, the more cars I make, the more antennas I have to install, so the more $3 as I have. However, the additional cost per unit per car is going to be $3 every time. So that's one thing. And then fixed costs don't change with output, which means as output changes, the unit cost changes. So if I had a fixed cost of $1 million for all of BMW X5s, let's say a lease cost, fixed cost, the more cars I produce, the less cost per unit. The fewer cars I produce, the more cost per unit. So it doesn't change in terms of total dollars, but it does change in terms of per unit cost. So you got to remember that. You can't, one of the big mistakes, and I'll jump to that in a second. Let's just look at a graph of a couple of variable and fixed costs. So here's your variable cost for steering wheel, $60 per X5. So every time we assemble a new car, we have another $60 for the steering wheel assembly. So when we get to 3,000 cars, we've got a couple of $100,000. I guess we had 3,000, we'd have $180,000. So each time we build a new car, the cost goes up. However, we have supervisory costs on the assembly line, which no matter how many cars we produce, they don't change. So, or within the relevant range anyway. So that's a $2 million cost, and it stays the same all the way across. Whether I'm producing 20,000 units or 60,000 units, my supervisory cost stays the same. And here's where you'd have get outside the relevant range. At some point, we're going to have to open a second assembly line to produce more cars, and we'll need more supervisors. But within the capacity of one assembly line, we have a fixed cost. Got to be careful when you use unit costs because they change. They're sometimes called average costs or unit costs because fixed costs are fixed. As volumes change, the unit cost changes. And you got to be careful when you start using unit costs because they're not the same at different levels of volume. So we've talked about direct costs, and we've talked about indirect costs, we've talked about variable costs, and we've talked about fixed costs. Any cost can be both either direct or indirect, and any cost can be variable or fixed. So you end up with direct and variable, direct and fixed, indirect and variable, indirect and fixed. So 4 different kinds of costs that we need to track. So let's look at a graphic of that. Back to BMW here, let's look at a graphic of that. So we've got variable cost. We've got the cost object is the BMW X5. We have tires used in the assembly of the automobile. So that's a direct cost and is variable because the more cars we produce, the more tires we need. An indirect variable cost would be the power costs, the electricity costs, because we only have 1 meter coming into the building. We don't directly trace the electricity costs to each production line. However, electricity costs go up and down based on some cost driver, number of cars produced, something like that. So power costs are variable but indirect. And then on fixed costs, the salary of the supervisor on the X5 line is a fixed cost, and it's also a direct cost. We can trace it directly to the X5. This person's job is to supervise the X5 line. So it's a direct cost, and it's directly traceable to the BMW X5s, but it's fixed. It's a salary. He or she gets the same amount of money for the whole year. It doesn't matter how many cars get produced. They have a fixed salary. And then we have a fixed cost that's indirect, and we already used this example of lease costs. the lease is for the whole plant where multiple products are produced. So it's indirect. We have to allocate it some portion of that lease cost to the X fund using some kind of a cost driver. So we've done an idea of what costs are, and then we're going to take a little bit of a look at the different kinds of firms and how they use costs. So there are basically three kinds of firms, three large sectors of firms. So companies that manufacture, companies that change the form of products. They buy something and they modify it and it becomes something different. BMW is certainly an example. We buy steel and we form it into cars. Buy lots of different components and form them into cars. So we purchase those materials and we convert them into finished products. Retailers, wholesalers, merchandising companies don't transform products. They merely buy products and resell them. So they don't change the form. Cost accounting for products is much easier for merchandising sector companies because they're not doing anything to the products. They have other complicated cost accounting problems, but product cost accounting is pretty easy for retailers and wholesalers. I bought this box that cost me $300 and has a TV inside it, and then I sell the box for more than I paid for it, but I know exactly what that TV cost me. So that's pretty easy. And then service sector companies also sell things, but they're intangible things. They sell education, they sell legal services or accounting services or dental services. They're selling a service, not a tangible product. And then that also means they don't have inventory, by the way. Excuse me 1 second. Sorry about that. Somebody wanted to sell me a free cruise or something. It was a junk call. So manufacturers have three kinds of inventory. They have direct materials, they have work in progress inventory, and they have finished goods inventory. So they have to track costs to each of these inventories. Now, direct materials, that's like buying the steel at BMW. That's relatively easy. They know what they paid for the steel. But now we're going to transform it. We're going to add labor to it, and we're going to end up with something transformed. And we're going to have work in process inventory that's not finished. And then when it's finished, we actually have finished or completed goods. And we need to track those for accounting purposes. So part of cost accounting is feeding the financial accounting system, because we have to have good costs in order to prepare balance sheets and income statements. What's the inventory on a balance sheet? Well, this is the cost of the inventory on a balance sheet. If we don't have good cost systems, we don't really know what the cost of the inventory on the balance sheet is. So those are inventoriable costs, which means that they don't become expenses immediately. They go into inventory, which is an asset, and only become an expense when we sell them. So here's your definitional information on direct materials, direct labor, and indirect manufacturing. As each item is purchased and or created, we charge them to an asset account, and then when we sell them, we record them as expenses. Things that are inventoriable, I just said, and then period costs, things that aren't inventoriable, get expensed at the time that they are incurred. So that would be like research and development, or administrative costs, or accounting and legal costs, that sort of thing. Those get expensed. They're not part of the product. I think I have a chart here. Yes, I do. Here we go. Let's look at this. So this is a sort of a flow chart for a manufacturer. We buy, and this is all on the balance sheet side, we buy direct material, it becomes direct material inventory. We pay for labor, and it's not expensed, as well as indirect manufacturing costs. It's not expensed. It becomes part of this inventory. Oops, we don't want to move these things around, do we? Becomes part of this inventory. So the direct material and the labor and indirect manufacturing costs become part of an asset called work in process inventory. I add some more labor and indirect manufacturing costs, and we finish this process and we end up with finished goods inventory, still an asset. During the year, some of those finished goods get sold and become an expense, and the rest end up in an ending inventory on the balance sheet, still an asset. Those are the goods that aren't sold. So we have a process here where we're adding things, costs, to inventory, to an asset, becomes an asset, and it's not a cost until we sell it. There's other kinds of things that we expense immediately. So these are period costs. So research and development, design, marketing, distribution, customer service. These things don't go through the balance sheet. They go direct to the income statement as expenses. And your income statement ends up with sales minus cost of goods sold, gross margin, operating expenses, and then you get operating income. So it's important that we have correct costs, because part of those costs end up on our balance sheet as assets. And we're telling people we own them and that they have value, and this is the value they have. So having good costs helps us make good decisions. And if we have a bad cost system, we may well make bad decisions. So we need costs to make pricing and product mix decisions. We need it if we're a government contractor or somebody working on a cost plus contract. We need good cost information so that we can bill our customers. So many government contracts are cost plus. So I'm building, if I'm DIW and I'm building a ship for the Navy, I may have a contract, but the contract states that I'm going to build this ship and it's going to be my costs plus 10% or something like that. So you've got to make sure you have the right costs if you want to do that. If you want to be successful, if you don't track your costs well, you won't be paid properly by your customer. In addition, the customer is going to look at your costs and audit them to make sure that you're not charging too much. So you better make sure that whatever you're doing is well documented and done correctly. And then we also need costs to prepare our financial statements. So we need it for decision making. Sometimes we need it for billing, and we always need it for financial statements. So I find this graphic here fairly useful. These are all the different kinds of costs that we might incur in a production environment. Research and development, design, production, which we spent most of our time talking about. Then once we've produced it, we have marketing costs, distribution costs, all those logistics costs, and customer service costs. So we have a lot of different kinds of costs, and they go to different places. So production costs go to financial statements. That goes directly to a financial statement. You need to know production costs. They're inventoriable. Design costs and R&D costs often will be part of my costs for cost plus reimbursement. And then this entire range of costs I need to know to make rational decisions on pricing and product mix. Should I build this product? How many should I build? What should I sell it for? That kind of stuff. Because all of these costs are involved in the cost of designing, building, and selling or delivering a product. So the 100% of these costs. So we need 3 different tranches of information there, which makes cost accounting quite difficult. So what is cost accounting, cost management all about? Well, first of all, we're trying to figure out what products, services, and cost objects cost. And these can be things we're selling. We can also use cost accounting to streamline our processes by figuring out what a particular process costs. The second thing they're used for is once we have this information, we may use this information for planning and control and evaluating the performance of various aspects of our operations, and then making decisions. So that's kind of the whole outline for cost accounting. We didn't talk about how you do it, but we did talk a lot about why we do it. And those of you who have had experience dealing with cost accounting in your business life, hopefully some of this resonated or maybe explained what some of the cost accountants are out there doing. Thanks very much. There'll be a couple of short follow-up questions and then one more set of lectures and one more video lecture, and then we'll be done for the semester. Thanks.